Have you ever wondered how a company like Zomato or MamaEarth suddenly becomes the talk of the town with an IPO? Everyone's like, did you apply? Did you get allotment? It doubled on listing day. But wait, what actually happens when a company goes public? And once it's public, how do these shares magically appear on our trading apps like Zerodha or Groww? Let's simplify the primary market and secondary market, the two big stages of our stock market drama. Imagine you're the founder of Coffee and Chill PFAT Limited, your startup that sells designer coffee mugs with motivational quotes like, "Rise and grind, business is booming, and now you need R100 crore to expand across India." So what do? You say, let's go public. That means you'll sell a part of your company to the public and raise funds. Welcome to the primary market. This is the market where a company issues shares for the first time to investors through something called an IPO, initial public offer. It's like your company's first day on the red carpet, all eyes on you. So how does this IPO thing actually happen? Let's break it down. Easy peasy. 1. Hire a merchant banker, underwriter. These are the professionals who guide your company through the IPO. Think of them as your personal wedding planners, but for your company's big debut. 2. File the draft red herring prospectus, DRHP, with SEBI. This document tells investors everything about your company, your business, profits, risks, and future plans. 3. SEBI approval. Once SEBI gives the green light, your IPO is ready to roll. 4. Price band and subscription. The company sets a price range, say Rs90, R100 per share. Investors then apply during the subscription period. 5. Allotment and listing. Shares are allotted and then the grand finale. Your company gets listed on a stock exchange like BSE or NSE. Now you're officially public, and your coffee mugs are on everyone's watch list. But what if the market crashes just before your IPO? That's where underwriters come in. They're like financial bodyguards. If not enough investors buy your shares, the underwriter will. This ensures price stability and confidence in your IPO. So basically, even if your stock gets stage fright on its debut, your underwriter is clapping in the front row. So now your shares are listed. What next? Welcome to the secondary market, where the real action happens. Here, investors buy and sell shares among themselves. The company doesn't get any money from these trades. It already raised funds in the primary market. Think of it like reselling concert tickets. The artist doesn't get more money, but fans keep trading them for profit. All these trades happen on organized platforms called stock exchanges, like BSE and NSE. Behind the scenes, we have depositories, like NSDL and CDSL. They hold your shares in demat, digital form. Think of them as your digital lockers for shares. Clearinghouses. They make sure every trade is settled smoothly, ensuring the buyer gets shares and the seller gets money. No chaos, no cheating, just smooth financial choreography. Now let's talk about the heroes and villains of the stock market, speculators and hedgers. Speculators love risk. They buy low, sell high, or at least they try. They're like the adrenaline junkies of Dalal Street. Hedgers, on the other hand, play safe. They use derivatives to protect themselves from losses. Think of them as investors wearing seatbelts. When you buy or sell a stock, you'll see options like market order. You buy at the current price. Quick, but sometimes pricey. Limit order. You set your price and wait. Patience pays off. Stop loss order. Your safety net. It automatically sells your stock if the price drops too much. And if the market goes too wild, up or down, circuit breakers kick in. They pause trading to prevent panic. Think of them as the stock market saying, "All right, folks, let's all take a deep breath." Finally, we live in a globalized world. Foreign investors pour money into Indian stocks, and Indian companies are listed on foreign exchanges too. So what happens on Wall Street often affects Dalal Street. That's why even if a sneeze happens in the US market, Indian stocks might catch a cold. So let's recap. Primary market is where companies raise money for the first time. Secondary market is where investors trade among themselves, and the entire system runs smoothly with exchanges, depositories, and clearinghouses. Whether you're a future investor, analyst, or entrepreneur, understanding this system is your first step into the world of finance. Don't forget to like, share, and subscribe to Quick Concepts. where we make finance easy, fun, and full of caffeine.